Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you refine your trading approach. In today's video, we are going to explore the time-weighted average price, which is also known as the TWAP trading strategy, a method designed to help you execute large orders more efficiently while minimizing market impact. So stay tuned as we break this down to what the TWAP is, how it works, and how you can apply it in a step-by-step approach to execute and improve your trading strategy. We start by understanding what this TWAP is. Now, the TWAP is the time-weighted average price and is a trading strategy designed to execute large orders without significantly impacting the market price. Instead of placing one large order that could disrupt the market, the TWAP breaks it into smaller orders executed at particular intervals over a specific period in time. This ensures that the average price of these trades align closely with the market's natural fluctuations during the time. This TWAP is particularly useful in liquid markets where sudden large orders can cause price spike or drop. So by spreading the trade evenly, it helps maintain the price stability and reduce slippages, which is the difference between expected price and actual execution. So you will notice that the TWAP focuses solely on time as its weighted factor, unlike other indicators like the VWAP, which incorporates trading volume into its calculation. This what makes the TWAP ideal for scenarios where time-based execution is prioritized over volume consideration. Now let's see how we can trade using the TWAP effectively. When trading using the time-weighted average price, that's the TWAP strategy, the goal is to execute large orders in small segments over a specific time period to achieve an average price close to the market natural movement. This approach ensures that your trades do not disrupt the market while maintaining control over execution. So to buy using the TWAP, you start by determining the total quantity you would wish to purchase. Divide this amount into smaller equal size portion based on your desired execution interval and the time frame you have chosen. Now for example, if you want to buy 100 units of Euro USD over 10 hours, you would have to split it into 1000 units per hour. These similar orders are then executed consistently at regular intervals, such as every 60 minutes. This smooth distribution reduces the risk of sudden price spike caused by large orders. So this is basically how the indicator shows over time, how smooth it follows price. So selling with the TWAP follows the same principle. You just need to define the total quantity you would want to sell and divide it into smaller portions and execute these portions at regular intervals over a selected time frame. So for instance, if you are selling a 5,000 units of GBP USD, put in the TWAP indicator. If you are selling a 5,000 units, a 50,000 units of the GBP USD over 5 hours, and you can see this is an hour time frame, you would have to split it and sell in intervals of 10 units every hour. This ensures that your trade is aligned with the market condition without causing a disrupt or abrupt price drop. Now let's see how we can split this into segments. So since we are making use of 5,000 units of GBP USD over an hour, remember one lot is equal to 100,000 units. So using a lot size of 0.5 to trade over 5 hours would give us whatever we are using to trade. You can sell 10,000 each for every hour, meaning you'll be using 0.1 lot size to move in your hourly time frame. This suggests that your trade has to be aligned with the market condition without causing an upshot in price drop. The efficiency or the effectiveness of the TWAP depends on maintaining consistent execution intervals and monitoring the market condition. While the TWAP is ideal for stable markets, it's essential to adjust your interval or segment size if liquidity or volatility changes during your trading session. So the TWAP formula is simply, it calculates the average price of an asset over a multiple interval by summing up the prices at each interval and dividing by the total number of intervals. For example, if a stock price at hourly intervals are $50, $155, $158, and $162, and the TWAP could be calculated as the $150 plus the $155 plus the $158 plus the $162 all over 4, which will give us $156.25. This is smoothing out any temporary fluctuation in price during that period in price. So these are the calculations of the TWAP using hourly intervals. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share, subscribe, and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.